Today's subject is investment law. Investment law in India has a vast canvas. The history of investment law in India is almost like 170 years, starting from almost 1850 to today is 2022. So that is this span of investment law in India. Comparatively, investment law in India, of modern India, compared to that, the early history, is very new. It is new because Indian development has got various phases. As we go on, we'll discuss about these phases, and then we discuss about the phase and the requirement of capital development, and the capital market growth. All this will pump in the money for investment in the industrial sector. Not only industrial sector, but also the agricultural sector. So investment law, therefore, can be of this type. Can be domestic investment, can be foreign investment. Domestic and foreign investment both can be direct and indirect. Now, once we said that, we come across the crux of the laws to see just the panoramic view of the legal structure of investment law. Law, as you all know, can be legislative piece, can be delegated, can also be administrative law. And there is, of course, the case-made law or decisions-made law, which we call precedent. Now, legislative pieces of investment law are Companies Act, Security Contract Regulation Act, Industrial Development Act, Security Exchange Board of India, Foreign Exchange Management Act, Competition Act, and Income Tax Act. These are predominantly concerned with investment climate in a country. Similarly, these acts then give the power to the executives and the regulators, mainly the regulators. The executives make rules, serve rules, and the regulators like SEBI has got regulations, then FEMA has got regulations, Security Contract Regulation Act has got regulations, and Competition Law Act has regulations. So all of them, Competition Commission has regulations, all of them has their rules. Rules are, as you know, framed by the executives, placed before the parliament for 30 days, over one session or two sessions, succeeding sessions, and then after being corrected if there is any advice, then promulgated. Regulations are also the same, but the difference is that regulations, once they are framed by the regulator can immediately notify for implementation, along with placing the regulation in the parliament for necessary opinion of the members. And if the members' opinion is different, then they can also rectify the regulations from time to time. But predominantly, the whole machinery functions on administrative law. These are by notifications, orders, circulars, guidelines, directives, instructions, advisory notes, and press notes. Each one of them are very important for day-to-day operations of investment law. Now, why investment? Any industry requires land, labor, capital, organization. Land it requires for the purpose of establishment of the industry. Labor, those are human resources. Capital, which is invested. Capital is the investment requirement. And organization is called management structure. So these are the four factors of production. And in the factors of production, capital, of course, is the most important or centric investment factor in the entire spectrum of industrial development. Let us now see a bit of history of investment law in India. Investment law, British capitalism and Indian national capitalism, capital growth, capital movement, as well as industrial growth, industrial history, these are all almost synonymous terms nowadays. Now, in investment law, generally we mean that it is investment in the industrial sector, but this is not true. Though, in many of the states nowadays, almost every state invite industrialists only for the purpose of investing in that state. But investment is not simply made for industrial capital; it is also agricultural need as well. But obviously, when we study here investment law, it is predominantly industrial growth and industrial capital movement. Now, the whole period of the last 200 years can be divided into three parts. Now, first part is British capital, movement of British capital. There was no Indian capital. Indian capitalism was not there. Indian corporate sector was not there as much as we say today. We have British capital, British companies, British domination in the industry in India. Now, but if you look at the country level, the Cambridge history says that in 1850, between 1850, the first major industry started, and in 1914, India had created the world's largest jute manufacturing industry, the fifth largest cotton textile industry, and the third largest railway network in the world. So it means that the industry was taking a kind of a shape during the British time, but it was only British capital. It was not Indian capital. Indian capital movement was not there at that time. And industrial sector was predominantly a license and permit oriented Raj during that time. Now the first Indian industry got the jute industrial license in 1894. That was the first Indian industry in the jute sector. Then the first cotton textile industry in the Indian sector, with the Indian capital, got the license in 1902 for the purpose of manufacturing khaki cloth only. Otherwise, manufacturing cloth in the industrial sector was absolutely prohibited because it was only dominated by the British capital. And India had to depend entirely for its clothing entirely on British capital, on Britain. It has to be imported. And then the first Indian iron and steel industry was in 1894, but that was a British industry called Bengal Iron and Steel Industrial Company. Bengal Iron and Steel Company started their function in 1897, but the entire production was taken over by the government of Bengal. Now then, the first Indian industry, Indian capital, got a license of iron and steel industry in 1907. Tata Iron and Steel Industry was started. Thereafter, in 1913, Bhadravati Mysore Steel Industry was started. And then the last was, during the British regime, last was Indian Iron and Steel Industry in Kutli. That was the last team, which ultimately took over Bengal Iron and Steel Industry Company. Now this is the industrial wealth, industrial capital movement in the hand of the Indians. Then of course, up to 1947, we find very few Indian industrialists in aluminium, very few, one or two in aluminium, one or two in cement, and then paper, Titagarh paper mill, but it was a British capital. Now these all started before 1947. So before 1947, this is a saga of British capital, though Indian capital movement started building up. The next phase, that was important. The next phase was from 1947 or 1948 straight you could take to 1987, 1986-87. 1947-48 is important because the first industrial policy was declared by the Government of India in 1948. Now, in that we find that Government of India also, following the British style, predominantly kept the capital growth in the with the government, because government has to play the lead role, because Indian capitalism was not there, or very less. Indian capitalism required to the need is very, very minimal. Therefore, it is the Government of India who came forward for setting up industries. In the initial stages, all iron industries, it was government to government. It was not like today. It was government to government. Say, for example, with the British government, Indian iron industry was established in Durgapur. With the German government cooperation, the Rourkela steel plant was started. Vilai was started with the cooperation of Soviet capital, erstwhile Soviet capital. Like that, it is the Indian capitalism grew with the government, predominantly government investments. Now, in our entire second phase, where government was the captain of the industrial development, all major industries of the country were in the government. And during this time, we had all the banks nationalized, most of the banks nationalized, 20 banks were nationalized, life insurance nationalized, all general insurance were nationalized. So all those nationalization as well as money spinners, the banking institutions were taken over by the government, and government actually was running the entire show of the building up of Indian capitalism or Indian capital in the industries. That continued up to 1986. Actually, it continued up to 1981, and then thereafter, the automobile industry was released, and gradually, government started releasing some of the important industrial areas to the private sector as well. Now, the major change was actually privatization, what we call, is with the Manmohan Singh taking over as the finance minister during the regime, prime ministership of Narasimha Rao, and this entire spectrum of industrial civilization start moving, and it was called a period of liberalization. Now, at the present moment, we find that most of the industries are liberalized under liberalization scheme. Most of the industries are available to the private sector, and Indian private sector is completely free to move in any industry, in any way, anywhere, except of course there are still some inhibitions in some of the small areas where industrialists are not allowed to move in. Otherwise, it is more or less for domestic capital, it is entirely now free in all industries. But for foreign industries, there are gradually liberalization policies taking over. Gradually, first initially in some of the industries, and gradually now we have come up to a kind of area where only about restricted areas, or 7 or 8 areas where there cannot be foreign funding, but other areas are allowed to foreign funding. Now let us go back to our drawing board. How to raise capital from where? So why capital? For the industrial production. How to raise capital? It may be raised from the domestic sources, from the countries within the country, and it may be also raised from outside the country. And when we say raise by what? By what way you can raise it? Now these are the following securities. We call it security. Security is an instrument for investment. A vehicle of investment is called security. So you have vehicle of investment called securities. Security Contract Regulation Act now lays down these types of securities. There are 2 types of securities. One is called owner's security. The other one is called debt security. Owner's security are called equity shares and preference shares. Debt securities are called debentures, debenture stock, debenture bond, and certificates. So you have, these are the vehicles of investment. Now these vehicles of investments, or called securities, are traded in domestic stock exchange, or foreign stock exchange. So traded in the stock exchanges. Now stock exchanges are the places of actually the capital market. So when we say capital market, the market where these capital instruments are traded between the existing shareholders and expected buyers. There is nothing to do with the companies. Company cannot raise their capital from the stock exchanges. Be very clear. Stock exchanges is only meant for the retail or even the wholesale buyers of stocks and shares, and the stocks and shares are then sold to the expectant buyers. Now these are the buyers and sellers game market, which is called stock exchanges, but this is called capital market. Why it is called capital market? Now when the stocks and shares are traded here, obviously capital instruments are traded here, so there will be demand and supply for that. And the demand and supply of the instruments, the price is fixed. This is called market capitalism, market capitalization. Market capitalization. So market capitalization is the price that is determined in the demand and supply of shares and stocks and debentures, that means securities. Now that price, whatever is the price determined by demand and supply, which is market driven, is a market driven price, determines the price of the share and the total value of the share capital of a company. Now that is called market capitalization. Now once we said that, this is called basics. Securities, these are basics. But recently, in our modern times, a second grade of security interest has been created, which is called derivatives. Debt and owners, this together, they create a kind of instrument, we can call it as hybrid instrument. Now it may look like owner's capital, but actually it is a debt capital. Like say, if it is non-redeemable preference share, non-redeemable preference share is actually a debt instrument, though it looks like preference share. Okay? So these hybrid instruments, there are many types of hybrid instruments created. Many types of hybrid instruments where you have 3/4 is equity, 1/4 of debt, or 1/4 of equity, 3/4 of debt. Now it looks like debt, but it is actually functions like equity. So it means that what is the difference between equity and debt? This is a vanishing point? in the investment world. We will discuss about that, whether this is a vanishing point in the investment world, because to investors, investment is more important, not the investment ownership. So actually we are creating a divide between ownership and investment. We thought this ownership and investment is the same thing, but it's not the same thing. Today in the investment market, with capital stock exchanges, when I go for as a buyer, I want to invest my money which I saved in some securities of some companies, right? Now when I do that, actually I am interested to invest and get the return. Invest and get the return. Price would be hiked. My anticipation is that price is going to be raised, and therefore I will get the difference. The differential price I will receive. Difference of price between the buying and the selling will be my earning. It is not that I am earning from a profit of the company. I do earn from the profit from the company, but it is pittance. Say for example, a share which is a face value of 10 rupees. Say Infosys share face value is 10 rupees. Okay, it sells sometimes something as 1200 rupees, supposing 1200 rupees. So I now buy at 1200 rupees a share of 10 rupee only. Dividend is declared on 10. So if the dividend is 300%, suppose Infosys dividend is 300%, then I get a dividend of 300% of 10, which is called 30 rupees. But if this trading is more, this 1200 rupees may go up to 2000 rupees, then I get a profit of 800 rupees. This may be overnight. I may get this profit overnight. So I am not interested to stick to the share of a company, though its dividend is 300%, 400%, 500%. I am not sticking to it. So I am not behaving, my behavior is not like an investor. My behavior is just like businessman to get the profit. Okay? So I am not actually owner. I am not behaving like an owner, I am behaving like an investor, to be very precise. I am not behaving like an owner. Means if I have an equity holder, I have the following special rights. What? Right to attend the general meeting, annual general meeting. 2, right to elect my directors. 3, right to appoint my management staff. 4, declare dividend. These are my inherent right. But I am not interested to attend the meeting at all. Right? So I am not behaving like an owner. I am behaving like an investor. So I go to the market and try to, every day, I go to try to see what is the market price of my share. The moment market price goes higher and higher and higher, I behave in that manner. Market determines my behavior. Market determines the behavior of an investor. Market doesn't determine the behavior of the owner. I hope I am clear on this. So you have second type of investment. This is the first type of investment, securities. First type of securities are this. Second type of securities are this. There is a third type of securities which are emerged, which are called derivatives. Derivatives are derived from the mainstream stocks. So, say for example, if I buy a stock, say Tata Chemicals, at the rate of say 10 rupees stock, I am buying say at the rate of 500 rupees. Okay? So I buy at the rate of 500 rupees. At the same time I buy an options. At the same time, buy an option, that I have an option to buy. I am buying this share. I have an option to sell. So So I have an option to sell. So I buy this option to sell from the same seller. I say, all right, I am buying your share, but I have an option to sell also you back. I have the option to sell you back within this much of time, for which I give, say, a separate price of, say, 25 paisa. Separate 25 paisa I give separately. Now the moment I said that, that option paper, that option agreement becomes itself a tradable security, and it is also the third type of security is called derivatives. Okay. So these are the various instruments through which capital market operate, capitals operate. So you have two types of capital. Ultimately we find that there are two types of capital. Ultimately we have found that there are two types of capital. One is called owner's capital. Owner's capital called equity. Ownership capital. And debt capital. This debt capital may be convertible, may be non-convertible. Convertible can be treated as an equity. If it is a debt capital can be converted, debt capital is equated as an equity. Whereas debt not convertible has to be paid. Has to be paid in the tenure time, which may be 20 years, maybe 20 years. As agreed upon. Not 20 years, as may be agreed upon. So this is the crux of the issue, that I raise capital. Types of capital, that is also again an important factor. There are two types of capital. Not only this, one is called fixed capital, the other one is called current capital. Okay, fixed capital is for fixed assets. Current capital is for short-term capital. Short-term is for, so it is a debt capital, short-term debt capital. There is a long-term debt capital, which is part of the capital. There is a short-term capital, which people generally get from bank overdraft. Generally this is current asset. Minus current liability plus cash. This gives you the current capital. Right. Now a question sometimes people ask, if you have debt capital and equity capital, how much equity owner's capital I must have, how much owner's capital to how much debt capital, how much owner's capital to how much debt capital. That means debt equity ratio, I am asking for a kind of equity debt ratio or debt equity ratio. How much current capital I can have for how much debt I shall incur. Generally it is called capital gearing. Capital gearing ratio. This capital gearing ratio is 1:2. That means if I have 1 rupee of my own from my own pocket, I can take 2 rupees from the loan market. So in a way, the virus of non-performing asset is in our capital structure itself. So it's in a way the equity and debt capital. If I have owner's capital, my capital 1 rupee, I can go to the market and get 2 rupee debt capital. Where from I get it? And for why should I get debt capital? Now I get debt capital for 2 purposes. One is long-term debt, which is part of my equity. That means I expand my capital. To expand my capital, people who have money which they want in a longer term perspective, as well as to become a partner of a company, becoming a partner, not shareholder but partner. Now they generally get this touch of capital, this debt capital to you. That's for one. Second one is that I have to get some capital for my current liabilities. So current liability. So this is our current liability, which I require for purchase of raw materials, paying of salaries and wages and paying rent. So all that current, which are called revenue expenditure, from where I meet, is called current liability. Okay. Now this is all. Therefore, this is general pattern of your capital structure. Now sources of capital. So you understand that if it is a long-term capital, which is called equity capital, we have equity instruments, and for debt capital we have debt instruments. Equity instruments are called equity shares or equity stock. Debt instruments are called debentures or debenture stock. So these are therefore 2 types of sources of capital. Now this capital therefore comes straight away. Now once we have this, there is a difference now which is heavily driven: ownership and management. Ownership and management is completely different now. Ownership is for governance, management is for managing the company. Okay? If it is ownership, completely governance, which determines actually the basic principles of governing the company, and management determines this day-to-day strategy of management. In this, whether I should take owner's capital or I should take debt capital is determined. This is called strategy. What would be the strategy? Based upon that, we generally determine the policy by the board. Board says, all right, our policy is that we take loan from every rupee of equity, 1.5 rupees loan. So this is called policy determination, and this is called actually practice, when policy is actuated into practice. Now, raising of capital. Which is called exactly the investment. So what I said is that when we say investment law, we perhaps forget that investment is not simply to become an owner. Investment is becoming an investor. So investor's interest and owner's interest may be same, may not be the same. An investor necessarily is not the owner. And when you own, you do not own the company. Shareholders are not the owners of the company. Shareholders are not the owners of the company. They are only investors of the company. Right? Shareholders, if they own anything, they are owners of only a share. Shareholders are not the owners of the company. Shareholders only owner of a share. His interest is vis-a-vis the company is to get the highest return. Vis-a-vis the company, if he is a long-term investor, his interest is to get a highest return. And with a short-term debt instrument or even long-term debt equity instrument, his interest is always like an investor to go to the market, resort to the market and take the market price high and low depending upon demand and supply of the share, and then accordingly he either buys or sells. Now, how do I raise share? One is the first category of share, the capital that I raise is from raising capital from signatories or sponsors. Raising capital from sponsors. 2, raising capital from shareholders. Those are expectant shareholders. Okay? So these are the 2 sources. Raising capital from sponsors and those raising capital for shareholders or stakeholders. You can sometimes say stakeholders. Because I have a stake in your company means I have a share in your company and I expect you to manage well to give me highest return. Now when you have these shareholders are who are there? They are general. They can be private or can be public. Private, public. Private means shares by private placement I sell. Privately I place the shares to you and you buy and then I get my money, I get my capital. When I have to have public, this is called public issue. I have to issue, public issue. And public issue may be initial public issue, it may be further public issue. So with this actually I start my business. It's called my capital. So land, labor, capital, organization. Land also requires capital. Labor also requires capital. Land requires capital which is called fixed capital. Labor requires capital which is called current capital. Organization requires salary remuneration is called current capital. Okay? And capital is for the purpose of productivity, production. So this is therefore key factor. Once it is this, I know that initial public issue is called IPO, initial public offer. Okay? Further public offer is called FPO. Further public offer. Right. All instruments can be sold like that, excepting that if it is option, option is created in the market only. Option doesn't have initial public offer or further public offer. It's not like that. Option is only in the market, created by the market and absorbed by the market. Similarly, other derivatives also. Put options, call options, those are called options. Put and call option, put or call option. So there are varieties of options. Now, if this public, when I say public, it means what? Public means resident in India. Income tax access resident in India, call Indians. Necessarily they may not be Indians. Resident of India is a person who resides within India for 180 days in the previous year. 182 days in the previous year is called resident in India. Or he resides 360 days in the previous 4 years. Or 765 days in the past 10 years plus 60 days in the previous year. Then they are called all resident in India. They are called Indians. It is not citizen. We are not concerned with citizenship anyway. We are concerned with resident in India. Or public may mean also resident in India plus resident not in India. resident in a foreign country. This is called foreign investment. This is called foreign investment, and this is called domestic investment. So domestic investment is this, foreign investment is this. Domestic investment, generally domestic investment is determined by A. Companies Act. Predominantly Companies Act determines the domestic investment. B. Predominantly the companion of the domestic investment with companion of Companies Act would be company rules on investment or share capital, as well as issue of share capital, or company regulations called SEBI regulations on share capital and disclosure regulations. This is 1906 is 2006 is perhaps the latest one, which is actually the realm of the domestic investment area. So there are two, these are two dominating, two actually, or three, they determine the domestic investment. Domestic investment, here law is determined by Companies Act, company rules, SEBI, share capital, and disclosure norm. Disclosure requirement. Regulations. So this is actually determined, that actually determines the domestic investment. If it is a foreign investment, then your law is determined by A, law is determined by A, FEMA, Foreign Exchange Management Act, Foreign Exchange Management Act, then FEMA rules, then you require DIPP, Department of Investment and Policy Planning, they at DIPP guidelines or notification, press notes, and FEMA regulations, for depository regulations. So this gives you the foreign investment. This gives you the Indian investment. So once we have laid down that, let us now go to understand who are the market players. Investor, of course, is the market player. If it is a domestic investment market player, domestic investment, then of course investor is the market player. Similarly, existing shareholder is a market player, investor. Then you have shareholder, or debenture holder, as the case may be. Then you have the most important factor called intermediaries. Intermediaries to the stock exchange. Now, a company, you may say that, oh, company, is it a market player? I write down here with actually very hesitatingly, because if the company is found near the market, capital market, if the company is found, company or any of the company officials are found near the market directly or indirectly, or indulging in any advertisement, it is called investors. For investors protection, it is called insider trading, and it is an offense. This is an offense. So a company or a company officials cannot be nearer to the market, capital market. Cannot be nearer to the capital market. So a company is, as a player, is simply because it has to raise capital from the shareholders by way of issuing prospectus or a statement in lieu of prospectus or a red herring prospectus or a shell prospectus, as the case may be. So intermediaries are most important, because without intermediaries you cannot access to the market, domestic market. Domestic capital market, you cannot access to domestic capital market without intermediaries. So we require an intermediary to enter into a shareholder, to enter into a market, or an investor to enter into a market requires an intermediary. Who are those intermediaries? They are called merchant bankers. Merchant bankers are called intermediaries. What do they do, merchant bankers? They are lead manager lead managers to public issue. Whenever you go for public issue, raising capital with public issue, you want to raise capital from the public by a public issue. Okay? You require a lead manager. Whenever you are raising by private placement, if the number is more than 200, you require a lead manager. Who can be a lead manager? A merchant banker can be a lead manager. What else he can do? He may be an underwriter, or a broker, or a financial advisor, underwriter, broker, or a market maker. Market maker, he may be a member of a price determination, he may be building the price builder. Okay. Now, most important of you obviously is the lead manager, because unless you have a lead manager, is a lead manager who has to take your prospect, draft the prospectus, the issue document, then submit the issue document, to SEBI, fulfill the requirement of SEBI, comply with SEBI, comply with SEBI requirements, and then finally issue the share. Then there can be issue banker, to the issue, can be investment banker, so he has all this to be done. A merchant banker. A merchant banker institution is extremely important for the capital market. Then of course there is a depository. There is a depository under Depositories Act. Today, if I buy a share, the share will not have my name. I will be only a number. So share has been digitalized. Entire market has been digitalized. So since entire market has been digitalized, I am only a number. My investment is only getting a depository receipt. But ownership requires specific name to be given. So actually my share is issued to a depository, and I get only depository receipt. I get only depository receipts. So what I am trading is not trading a share. I am trading only a depository receipts. So a company to raise capital from the share market, the first one condition is that its shares must be put to a depository. All the shares must be put to a depository. So depository has to have now a list of shareholders, and exactly based upon that allots number, and I have the only a receipt of that number, and this number depository receipts are actually traded. Now this is the Indian market so far as domestic capital is concerned. If it is a foreign capital, foreign capital can be raised in two ways. Obviously I said this is all direct. Foreign capital direct. If it is a foreign capital direct, then I have only an issue which is called, I enlist my issue of ADR, American Depository Receipts, or GDR, Global Depository Receipts. So I issue this depository receipts actually, these depository receipts. Now these shares are also, when I am selling my shares to a foreigner, he also cannot get the share. He can only get a depository receipt. And in the depository receipt, you have exactly the receipt number of the share against which this deposit ADR, GDR is issued to him. So ADR, GDR is listed in a foreign country, foreign stock exchange. So if ADR, GDR is listed in a foreign stock exchange, I am getting my foreign investment to ADR, GDR. So every issue that I make, public issue that I make, suppose I am making a public issue, the question is, can I now take the money, public issue, to American investors? Can a company in India issue directly, through public issue, take investment money from Americans or American residents? The main question is that if it is a direct, it cannot go and list its own share cap shares. Shares are not listed. What would be listed is a depository receipt is listed, ADR is listed, American depository receipt is listed, and this listing, whenever you have a kind of listed, you have a share here, a share in the market is depository receipt to be equated, to be shown as a kind of parallel. So what happens is, when I sell my ADR, I will sell my ADR afterwards. When I sell my ADR, when I sell it, now it will be automatically linking the depositories in India. In India, who has a list of shares against which this ADR is issued. So, a particular share. This share, then he will transfer this share to, so depository will transfer the share to the coordinator, you can say, kind of trust, kind of a trust. Now he will sell the share and give the money back to the American depository holder. So this is direct. If I am directly trading, once again, I directly want to take the foreign fund. If I have to do that, if I can do that, I always say can do. Can I do? That is the question. There's $1 million question. That will come later on. So if I can do, then what shall I do is that I shall list my ADR in New York Stock Exchange, or Nasdaq Stock Exchange, or Singapore Stock Exchange, or anywhere, Hong Kong Stock Exchange. So I list my ADR or GDR there, and once this depository receipts are sold, I get the money, my capital is raised. Foreign capital is raised from the public, American public. If I can get the direct funding I can get the money from American depositories. If I can get, who can tell me whether I can get or not get? Now it is a FEMA which shall tell me whether I can get or not get. FEMA section 6 is therefore the most important section for foreign direct investment. Now, if I can do that, then in that case I list a foreign depository receipt, an ADR or a GDR. I list it in a foreign market, capital market. Now, once I list that foreign capital market, then I actually get a ADR or American depository receipt. So actually there is an American depository who issues this depository receipt. So there is an American depository, US depository. So there is, in the US side, there is a US depository. So there is a US depository, there is an Indian depository. Indian depository will have Indian company shares. US depository shall have AD, American depository receipt. So I actually buy an American depository receipt. I do not buy Indian company share at all. But these are linked. Indian share and American depository, these are linked, identical, a share to a particular ADR. So every number here is actually the equivalent number in ADR as well. So there is an ADR number to each Indian share. So when suppose I am an ADR holder, I now want to sell my ADR. So I go to the market and sell my ADR. So I instruct my US depository to sell my ADR US depository immediately goes to Indian depository and sell this share. You have to sell it. So they earmark that share and send it to the Indian custodian. Indian custodian. Indian custodian. Indian custodian. So allocate the share to Indian custodian. Send the share to the Indian custodian. Indian custodian, then Indian custodian sells it to the Indian market. Then goes to this stock exchange and sells it. Now this money is then given to ADR holder. This is how circuitous, the whole thing. Though it looks to be circuitous, but in the digital world it makes maybe a few seconds or a few minutes. This is how the market players, these are the market players. So who are the market players in foreign investment? The market player is one, the American Depository, American Stock Exchange, American Depository or Foreign Stock Exchange, Foreign Depository, then C, the Foreign Custodian, then D, the shareholder, depository holder. So these are the players. Now you will find that there is no merchant banker here. So Government of India in recent time, about 6-7 months back, easing the foreign exchange. When easing the foreign exchange, there was a policy declaration that Indian company can now directly list as soon as there is an IPR, as soon as there is an IPO or FPO, it can be listed directly in the New York Stock Exchange as well, New York or Nasdaq or anywhere, any foreign, Tokyo, Beijing, anywhere. Now once they say that it can be done directly, that means how can I do it? List my share to the stock exchange. So stock exchange share has to be listed. So there is a procedure for listing my stock in the New York Stock Exchange. Now New York Stock Exchange is governed by New York Stock Exchange by rules. And since I am out of that rule, it is not necessary for me. So what remains to be seen is that when I say that list it, I apply according to their requirement. Whatever their requirement, New York Stock Exchange requirement is this. There is a lot disclosure norms required. Lot disclosure norms much higher than the disclosure requirement in our regulation. We have a regulation, disclosure regulation, I told you, is higher than that regulation. They have a disclosure norms. So they have a disclosure norm, they have a corporate governance more tight. Therefore, those things, if not done, it will be difficult to enlist our share in their stock exchange. So enlisting our share, that means Indian share or Indian company share to a foreign stock exchange, depends upon that foreign stock exchanges by rules. And since their by rules require very stringent corporate management system, disclosure norms, insider trading norms, so it is very difficult without altering our law to actually allow our Indian companies to enlist their stock directly in the foreign stock exchange. So what exactly then, what the government wants? Government wants that as soon as you enlist it here, your stock listed in Bombay Stock Exchange, you also list your ADR in American Stock Exchange, in any American stock exchange. You also enlist your stock, either Nasdaq or New York Stock Exchange. Now, why should I do that? It is because that your intermediary cost, the entire intermediary cost would be saved. Why I have to go for New York Stock Exchange enlistment? Because you do not require merchant banker there at all. So company can directly go to and fulfill the requirement, go and apply and get it listed. Okay? So entire intermediary cost would be, issue cost would come down. But since our law is different and having different standard, your stock cannot be listed in the New York Stock Exchange. So what you have to do is you have to give imagery. I cannot be listed, but my host can be listed. So I cannot be listed, my share cannot be listed, but American Depository receipt can be listed. So image. So that image is listed over there, and it doesn't have this cost at all. Immediately, okay, not afterwards. Now at the present moment you do it afterwards. First issue, then go to ADR. ADR issue is taken completely different. So issues that go to ADR is completely different. It is not in the same classified list. Okay, classified list, unless you have an investment banker. Now I think up to this is, I think it is clear. So I now go for next requirement. That is called procedure of capital being raised. What would be the procedure? Foreign investment. What are the procedure now? So who can go for foreign investment? Who can go for foreign investment? A person not resident in India. A person not resident in India is a person who is entitled to have foreign investment. Okay? Who else? Is there anybody else? OCB, foreign commercial banks giving loan, foreign commercial extending loan, they could not do foreign investment earlier. Now they are converted into investment bank. Now they can invest. Now anybody else? So OCBs who are now investment bankers can invest. Companies registered outside India. Actually, he is also a non-resident in India. Company registered outside India. though doing business in India, but registered outside India. Now they are capable of investing in India. Can foreign individuals, that means non-resident individuals, can they do through investment bankers? They're indirect investment, called indirect investment. Foreign investment for what? This is now for what? It's called sector specific plan through routes, any of the two routes. There are two routes. Number one is called automatic route. Automatic route. Automatic, that means you do not require anybody's permission, nothing. You can directly do it. Two, called approval route. So you require, before investment in India, you have to first take approval and then come to India. So there is an approval route, there is an automatic route. So it is sector specific, either automatic route or approval route. Now it may be these two may be 100%. So it may be automatic 100%, automatic approval route 100%. Okay, automatic 100%. Or less than 100%. Generally, it is 24% to 74%. 24, 49, 74. Three important landmark. 24% means you cannot have any board member, your shareholders cannot elect any board members. So only 24% you can buy. Like say, if you want to buy private insurance companies, foreign investment, you require it by a private insurance company, like a Axis insurance company, or there are so many. That private insurance companies, they can acquire foreign investment up to 24%, not more than that. And that can be automatic. It can be automatic. And if it is with approval, first you take the approval, then you can only 24%, like that. Then 49%, that means you cannot appoint one director into the board of directors. You are not in the party of the management, but you are not a joint venturer. Okay, you are not a joint venturer, but you are 49% shareholder, substantial shareholder. You call substantial shareholder. Like say, if you want to buy a company, say a bank wants to, say a private bank like say Yes Bank. Yes Bank wants to acquire now private funding, acquire foreign funding into Yes Bank. In that case, it can come up to 49%. 49%. If it is automatic, automatic. If it is not automatic approval, then approval. But not more than 49%. Similarly, many of the defense materials, now they are open. They come up to 49% with permission, with approval. Then there are some which are 74%. 74 up to 74% sectors, like say wholesale trade. Wholesale trade. So if it is a wholesale market like Mitra, they want foreign funding, they can come up to 74%. They can come up to 74%. 26% will still remain. That means minority interest shall be still there with the Indians. There can be a stipulation by the law, that management must be with the Indian company, must be with the Indian party. So this is how it is divided. It may be 100% automatic. It will be less than 100% automatic. It will be 100% but approval, but it will be less than 100% but approval. So these are the two routes through which foreign fund can enter into India. Right. If it goes inside your brain, I do not know whether it will go inside the brain. Now we can get to the next. Now, it comes to foreign, when we say foreign investment, it comes to the foreign investment or Indian investment, whatever. It comes on the capital market, but mostly when it's money concerned, it comes on the money market also. Dollar is a money market, it's a money market instrument, but it's not a capital market instrument in India. So you can have a dollar in your pocket, but you cannot get the money out of that. You cannot purchase money, it doesn't have a purchasing power. So if it is treated as a money market, then money is equivalent. Now that's a cryptocurrency coming, which now wants to have a kind of free flow, dollar into cryptocurrency equivalent to a dollar, cryptocurrency equivalent to rupee. So through cryptocurrency, the currency movement will start it. Money market. Now money market players, who are the money market players? As you have capital market players, we showed, those are the capital market players or intermediaries. Money market intermediaries are called authorized dealers. Authorized dealers. This is the number one category. And the second category called money changers. If you have a dollar in your pocket, you can go to a money changer, he will give you a rupee. I do not know whether you have seen a money changer, but any 5-star hotel, 5-star, 3-star hotel, 3-star, 4-star, 5-star hotels, they become money changers. They register with the RBI for changing the money. So they can buy foreign currency, but they cannot sell. No sell. They can receive from dollar, but they cannot give you dollar. Suppose you are giving $10 to me, actually you have to give me say $5, but you do not have $5 in your pocket, you have $10 in your pocket, you give me $10. I cannot give you $5. If I am a hotelier, I cannot give you $5. I can give you maximum worth of $5. Money of $5. Rupee of $5. Rupee equivalent of $5. Only if you go to authorized dealer, then he can buy and sell both. He can do both. So if you have $1 in your pocket, you go to an authorized dealer, he will first ask you, how do you get this $1? If you ask this money changer, he will not ask you anything. So you have to show your credentials, then he can buy as well as he can sell. He can buy $5 from you against that and give you another $5 to you. Possible. But money changer cannot do. So these are the two money market players. So all foreign currencies. So this is India. All foreign currencies stop here. Foreign currency cannot go enter into. No Delhi, stop here. So dollar cannot go inside at all. No dollar can go inside. So when I say foreign funding, I get foreign funding. What does it mean? Foreign capital. When I get foreign capital, what do I get really? I am selling American Depository receipt. When I sell American Depository receipt, I get what? I get an American Depository, and I sell American Depository receipt, I get $1, right? I get $1. This dollar, when I want to bring to my company, I cannot enter into. It comes and stops here. It cannot come through Bombay, no. So all stop, gates are stop, all flying stop. So what do I get then? I get dollar converted into, I get here, go to an AD, convert that into rupee, and that rupee comes here, my registered office. Okay, so all transactions must be, this is called usual banking route. This is called usual banking route. All foreign investment, all foreign investment in the usual banking route means go to an authorized dealer. Authorized dealer will receive dollar and pay rupee to Indian company. Suppose I want to raise foreign fund for agriculture development in my agricultural field, for my agriculture. So sector wise, I said already, foreign investment shall be sector wise. It shall be sector wise planned. So one of the sector is called agriculture sector. So I go and apply, I want to raise capital. So what do? I have a producer company. Agriculture can have a producer company. Companies Act has provided producer company. Producer company can have capital. So if I want to raise capital from the public and also from American Depository Receipt, I go to America, US, American Depository Receipt ADR. I want to do that. Can I do it? The sector-wise specific rule says no, you cannot do that. Why? Because agriculture cannot have foreign capital. Agriculture cannot have foreign capital. Sector closed for foreign capital. Okay. One of the irritation point of Punjab agriculturists is that they can get foreign funding, they can get lot of money from Canada, but they are unable to get for the development of agriculture because agriculture is completely closed. Excepting, there are exceptions also. So agriculture cannot be excepting in floriculture. Produce flower, you will get. Horticulture, sericulture, pisciculture, interestingly, it says seed research. So if I am a seed research firm, I establish a seed research firm, I can get foreign funding. If I have a poultry, I can get foreign funding. If I have floriculture, flowers, I can get foreign funding. If I have horticulture, if I have sericulture, if I have pisciculture, if I have seed research, and then says, very interestingly, vegetable production. Mushroom like vegetable production or mushroom production. For this, if I produce in a controlled condition, if I produce in a controlled condition, I can get. So if it is a controlled condition, I can get. What is the controlled condition? That means I can control the atmospheric, the climatic, the water supply. You can control all those factors called greenhouse operations. Okay? Then in that case, I can get foreign funding. Now if you go to airport, from the aerial survey you will see many of the green farms have come. Greenhouse farming started. Have you seen that? I do not know. The greenhouse farming, now they are actually producing controlled condition. That means they are controlling the temperature, controlling the water supply. So if they control the water supply, control the temperature, control the weather condition as required on and off, then in that case, even if they are producing vegetable, they can get. So my client says this: I want to acquire 3,000 acres of land. My foreign client, a client from Singapore, asking me that I want to acquire 3,000 acres of seashore barren lands, and convert that into a production land for producing banana, right? And I am interested to bring 100% foreign investment for that purpose. It was for the purpose of 100% export. So what are my take? Banana cultivation. Cultivation. So once you say cultivation, all type of cultivation, including farmhouse, construction of farmhouse, these are completely banned. So my first point is that if it is a banana cultivation, boss, I am sorry, you cannot bring foreign funding in India. That's number one. Number two, 3,000 acres of land. How do you acquire that land? So land acquisition. So our problem is one by one, land. So land, I said 3,000 acres of land, how do you procure? Because in India, land is not a subject of foreign investment at all. Land is not a subject of foreign investment at all. So you cannot buy land. It is not possible to have land. But supposing you want to still insist on, then a company can buy land. A company can buy land, say 25 or 100 acres for its own use. So 3,000 acres, you have to have 30 companies. You have to have 30 companies for that, registered for that purpose. 30 companies you have to register for that purpose. Is it possible? Then even if it is possible, it is not difficult to register 30 companies, private limited company, all closed circuit companies. They can use 400 acres of land for their company's use. Then the question would be, if it is banana cultivation, it is closed. Cultivation any form, excepting tea cultivation, no other cultivation is permitted. You cannot bring any foreign funding for timber cultivation, banana cultivation, or tapioca cultivation, oilseed cultivation, no way. So if it is cultivation, no. But maybe if you bring under horticulture, banana is a horticulture? Is banana a fruit? If banana is treated as a fruit, comes under horticulture, then it is 100% you can get. So first thing is that I have to do that. 100%. So you require aggregator here, land aggregator. You can have horticulture. And you have control condition production. Floriculture, horticulture, sericulture, pisciculture, seed research, vegetable production, provided there is a controlled condition, production in controlled condition. So these are the three requirements. Now if you find that in controlled condition, production cost is very prohibitive, something you say production cost is $1.5 and your banana cannot be sold at a higher price than, each banana cannot be sold for a higher price than say 0.50. In that case, it is financially non-viable. The institution that takes the central place in the whole investment law is called investment banking, which is nothing but a non-banking financial company, NBFC. Now, we have done that one group of NBFCs, they are called non-fund based NBFC, and they are intermediaries. They are playing the role of intermediaries in the whole capital market. As we said, that there may be lead manager, there will be underwriter, there will be broker. So they are one group of people, institutions, and the second group of institutions are called fund-based intermediaries, fund-based NBFC. These fund-based NBFCs, they take public deposit. They accept public deposit. Deposit for schemes. These schemes are of various types. Like say, only equity. So equity-based schemes. Or say debt-based schemes. Or maybe 50-50, 50-50 or 25-75 or 75-25. This is fully debt, 100% debt is 100% equity based upon risk. This is the highest risk. Investor must know that this is the highest risk investment. Highest risk investment is this. And the lowest risk investment is this. So, in between this, the investor has got a choice. These are the various other choices in between that, in between this. Now, these fund-based NBFCs, they get the public deposit for creating fund. This for creating fund. This fund is then investment in this institution, in this instruments. So these are called instruments. They are called instruments. This is fund based. They accept public deposit, create fund. Out of that fund, then the manager, the fund manager, there is a fund manager, investment banker has a fund manager. They now invest based upon the appetite of taking the risk. Some people want high risk instrument, some people want low risk instruments. Now there are various funds also, like this fund, based upon this investment banker, there will be venture capitalist, okay. There may be angel funding. So these are all bank fund or scheme fund. So all these are therefore coming into this question of public deposit, take public deposit, and then fund manager that invests. This is called indirect investment by public. Indirect. Direct investment and indirect investment. It may be domestic, it may be foreign as well. The other is that there is a virtual change of the banking policy of the Reserve Bank.
earlier commercial banks were not allowed to go for industrial banking. Now commercial banks are also allowed to go for industrial banking with a certain restrictions. And most of the commercial banks, almost all of the commercial banks have been declared as authorized dealers. Authorized dealers are those who can deal with the foreign exchange either for buying foreign exchange or for selling foreign exchange. So whenever there is a foreign funding possible in India, either in the form of equity or in the form of loan, they have to come through the usual banking route, and this is the usual banking route, that they go to authorized dealer, their authorized dealer, which is a bank. From that bank they will come to an Indian bank which is an authorized dealer, and then from that authorized dealer the money can be received by the investee. Now once you know this background, that these fund investment companies, they operate, and they, through them only public can invest in the. So if I have to invest say 100 rupees, I can go to directly to the stock exchange and buy a share. Okay, that is number one. I may not do that because I am not very happy with the operations in the stock exchanges. So I go and invest this money with a investment banker, like say Bajaj Capital investment banker. I put my money there, and they put then that money in any of these schemes. They will ask me what is my appetite. They have to know my appetite. So if they say, do you require high risk, then that is the equity. They will buy 100% equity share in that, in many companies. So my 10 rupee may be spread over 1 rupee here, 1 rupee there, 1 rupee there, 1 rupee there, 1 rupee there, and then aggregate I receive dividend. So these are the two ways: direct investment, indirect investment. Direct, I go and buy. Indirect, well, I buy through the fund management. Okay, so this is both in the domestic market as well as in the foreign market. So I have how many types of funding? I have overseas banking companies, overseas banking companies or overseas investment companies. I have domestic investment companies. I may have, just like domestic investment, like UTI is a domestic investment company. Overseas, there are so many overseas companies. They may take very high risk, very high risk funding. So this is called venture capital. Very high risk, high funding, who are investing in research. And generally they invest in a company which produces intellectual property rights. They do not have tangible property, it is all intangible, unseen. In that they invest. So if they invest in that, suppose there is a molecule which cures say COVID. Now if a molecule is found out in the laboratory of curing COVID, in that case that molecule give medicine, converted into medicine, it will give very high profit. So they will get very high profit. But supposing that fails, experiment fails, they will get zero. Their entire money will be wasted in research. So that is a type of venture capital which you have now. Then you have angel funding. Now who generally rescues the management, rescues. If the management fails, generally then they go for angel funding. Angel funding, with that they rescue their project. Now once you said that, we are ready for now two things. One is domestic investment. Now once the domestic investment is, we have already studied. Domestic investment, if we have, it almost looks like this. It may be equity based domestic investment, it may be debt based domestic investment, this is our capital, domestic capital. A company is domestic, this is domestic capital. It is comprised of public investment, called IPOs or FPOs, sponsors capital, then it has like say employees stock options. Employee stock options, then it has preferential investment or preferential investors. Then you have private placement. Then you have bonus share. Then you have a bonus share. Then you have issue without cash consideration. That means some directors are given some shares, they do not contribute, they do not pay the money, but they get the share. These are called issues without cash consideration. The total would be my share capital. Total would be share capital. Then you have foreign capital, domestic capital plus foreign capital. Foreign capital can be also debt based, equity based, debt based. This debt based is called overseas debt. Overseas debt. Equity based, debt based. This gives you foreign capital. So these two together is called total capital of the company. Right. So the entire capital block is like this. Now the question is, can a company go to the foreign capital directly? That is the question. Can a company in India go to the foreign capital directly? Now we have already discussed that a company wanting to raise capital may issue IPO, and at the same time, if it is 100% automatic route, in the automatic route, it may also list its share in New York Stock Exchange, and New York Stock Exchange people will sell American depository receipts, or dollar depository receipts, against which an Indian share would be allocated. Now this is how it is done. The question is that we have raised this issue, that routes of foreign investment. We have raised the issue of routes of foreign investments. Routes of foreign investment. Now routes of foreign investments predominantly are two. One is automatic. That means you need not take any approval from anybody, no license, no permission. You can go ahead and raise capital in the foreign capital market. or it can be approval route. Approval route means that before you raise capital in the foreign capital market, you have to get approval from the Government of India. So these are the two routes. So absolutely divided two routes. Now these two routes can again be subdivided into 100%, which we have already seen. 100%, that means 100% automatic. So I can take, if my whole capital, total capital of a company is say 100 rupees, I can take 100 rupees from foreign market. That is called 100% automatic, and I did not go to the company, I did not go to the Government of India, or did not go to Reserve Bank for getting prior permission. Approval route is that I have to go to the government, get the approval, and government will give the approval. After that approval only, I can be 100%, I can be 74%, 49%, 24%. This we have already seen, that these three figures are extremely important. So after getting permission, there are some items where I can have 100% investment, some items, not all. There are some items, some industries or some sectors, it is called sectoral guideline. In the sectoral guideline, they say these are the sectors where it is 100%, these are the sectors where it is 74%, it is 49%, it is 24%. That means that I can invest in the foreign market, I can take foreign capital, but with the approval of the Government of India. I think now this background is clear. With this background, let us see one thing, that entire foreign capital, foreign investment only, not domestic investment. I am not talking about much of domestic investment, because domestic investments, there is no restriction now. If you go to the history of domestic investment, Indian investment law has got about 150 years of history. In this 150 years of history, you can just take before 1947 as one group. So 1850 to 1947, 1850 to 1947 is a history where it is again permission license Raj, completely permission and license. The Britishers used to give license, Britishers used to give also permission. Now actually therefore it was the British capitalism. There was no Indian capital, Swadeshi capitalism was not there. If you look at the history of industrialization, you will find that it is British capital dominating from 1850 to 1947. Indian capital was very less, Indian capitalists were very less. Now the first industry, which actually India was stopping, by 1917, India actually was the top industry, having the top industry in jute textiles. So India was leading the entire world in jute textiles in 1917, 1918. Jute industry, but it was completely funded by British capital from Dundee. Dundee was the center for jute industrial headquarter in London, and Dundee investors used to invest in jute industry in Calcutta. So first jute mills were started by a British firm, British company in 1857 or 56, and then the last one, Basberia, was established in 1946. So that was all British enterprise. There were very less Indian enterprise. Indians used to produce jute and prepare jute gunnies. Then the gunnies were exported to Dundee initially. Dundee had experimented with gunny bags, but it could succeed because the price was high. So they established their industry here in India. That is from 1850 to 1947. Then the next industry which was important was cotton textile. As you know that Indians were not giving the license for the purpose of manufacturing cloth they could only get the thread, produce the thread, okay, but they could not produce the cloth. After producing the thread, they used to supply, they have to export cotton and cotton guineas and cotton threads to Lancashire, and there it was various companies, there were various companies, they used to produce cloth, and that cloth used to come to India and Indians used to buy that cloth. Now that was a machine cloth, machine made cloth, it was not handmade. Only handlooms were restrictively allowed, only handlooms are restrictively allowed. In 1902, first time, 1902, Britishers gave license to Indian industrialists for producing khaki cloth for their military purposes. They are in short supply in military purposes, cloth, khaki cloth, so they gave the Indian manufacturers license for producing khaki cloth, and that's how British industry was now competing with the Indian industrialists in Bombay. So cotton textiles started in Bombay, jute textiles in Calcutta. These are the two dominantly industrial centers. There were, next industry was iron and steel. You know, iron and steel, as Jawaharlal Nehru used to say, that steel consumption of a country determines how much it is industrialized. Steel consumption per capita determines how much you are progressing in the industrial development. Now, we understand that I am not talking about domestic investment, because domestic investment comes under corporate, we have already discussed that. Domestic investment comes with the corporate finance. That gives you domestic investment. Now, whatever we have discussed about corporate finance, we have all discussed earlier about the corporate finance, that is all domestic investment, but we now concentrating on foreign investment direct, foreign investment indirect. This is direct. There can be another investment called indirect foreign investment. Indirect, that means a foreigner invests the money with a fund, dollar is given to a fund comes to India and buys shares in the stock market. So fund comes and buys shares based upon a scheme. So this is the indirect one. So direct investment, indirect investment. Direct investment, automatic 100%, or approved route 100%, 74%, 49%, 22, 24%, whatever it is. Now these are all based upon sectoral limit. Government of India every year now comes with a policy decision of sectoral allowance of foreign investment. Sectoral allowance of foreign investment. Now you can see the first sector was agriculture. Now these are already noted. Who can take foreign direct investment? Foreign direct investment. That means investor comes directly to the company and gives the money. Money can be given either by equity or by a debt. Now who can do that? A non-resident entity. That means a company registered outside India. OCB, overseas commercial banks. Now overseas commercial banks, after they have converted into NRE, non-resident externals entity, non-resident external entity, then only they can invest foreign direct investment. NRI of Nepal and Bhutan, as well as citizens of Nepal and Bhutan, but not Bangladesh and Pakistan. Bangladesh and Pakistanis are not allowed to invest in India. Then company, trust, partnership, firm, incorporated, established, trust, partnership, company, trust, partnership, firm, incorporated, established outside India and controlled by NRI. This is only for NRI privilege. And NRI having a company, trust, partnership, firm outside India, they can bring money in India. Then foreign portfolio investor, these are called foreign portfolio investors. These foreign portfolio investor, so these firms are portfolio investors. They invest in portfolio. Portfolio means various companies' shares they can buy. So the portfolio investor. Then you have issue capital against FDI directly on private placement or a public issue. That country of foreigner can invest in the countries, our company. NRI investment. Then prior approval of the RBI, this section, prior approval of the RBI, these are foreign institutional investors, FIs, and through inward remittances by NRI and NR. Now, people who are working outside India, they send their money to India. So that is also a foreign money that you earn, and that is also invested. Now, in these sectors, there cannot be any foreign investment. Foreign investment is completely prohibited in these sectors. A lottery business, so you have all the, every newspaper publishes hundreds of lottery. Now, this lottery business cannot be funded by foreign money. Gaming and betting, cheat fund, nidhi, trading and TDS, real estate business. This is extremely important. Now, with foreign funding, I cannot establish a company, take foreign funding, and then with that fund I buy property and sell property. Buy property, Indian property, and sell Indian property. That is not possible. So it is completely, real estate business is completely out. But it doesn't include development of real estate. It only real estate business. That means buying and selling a plot of land, okay, with the foreign money is completely out. Manufacturing tobacco goods, no foreign funding is allowed. Activities open to private sector investment, like say atomic energy, private sector cannot invest. It is not meant for private sector, domestic as well as foreign. Similarly, railway operations, even today railway operations, but not railway infrastructure. This government has actually given railway infrastructure to the private sector. So before this government, entire railway was maintained by the Government of India. Now Government of India only now operates railway operations, and therefore no foreign funding in railway operations, but foreign fundings are now possible 100% in railway infrastructure building. Then agriculture. Agriculture also is out of foreign investment. There is no foreign investment in agriculture. Right? Okay. Now agriculture includes all this: floriculture, horticulture. These are all included. Sericulture, pisciculture. These cultures are all as a part of agriculture. But see, these cultures are outside agriculture. When we say agriculture cannot be foreign funded, only agricultural activities which are producing crops, these are completely outside the foreign funding. So foreign funding cannot be taken for producing, say, tomatoes, or producing, say, rice, paddy, or say jute, or say it cannot be, you cannot bring in that at all. But if it is a floriculture, horticulture, cultivation of vegetables under controlled condition. Now if you have greenhouse operations where you can control the temperature, control the rainfall, water supply, in that controlled condition, production in controlled condition, if you produce vegetable or if you produce seeds, that is quite permissible with foreign funding. Complete foreign funding you can take, 100% an automatic route. So you need not go to the government, you need not apply anybody, you can take foreign funding and you can actually start cultivation. But it has to be only in controlled condition. That means in air conditioned agriculture, in air conditioned system. Not only air conditioned, it is water conditioned system. The controlled condition. In that only you can take foreign funding. Development of production of seeds, you can use foreign funding. Now, machines for planting materials, foreign funding is allowed. Foreign funding is allowed in animal husbandry, pisciculture, aquaculture, sericulture, apiculture. Here 100% foreign funding is possible. Agro services and allied, say tomato ketchup or say potato chips. These are all agro services and allied sectors or industry, agro industries. Here also foreign funding is allowed, and it is 100% automatic route. Plantation, India is one of the important country for plantation management and plantation products. But you can see that these are the plantations which can take 100% automatic route. Tea plantation, coffee, rubbers, cardamom, palm oil tree and olive oil tree. 1, 2, 3, 4, 5, 6. Besides these 6, you cannot take any plantation for foreign funding. You cannot take foreign money for any other plantation. Now, we discussed some times back that one of our client who wanted to have banana cultivation. Banana cultivation. Now the question is, banana cultivation, is it a plantation? Banana can be planted. It is a plantation. We say banana plantation. So what is the difference between plantation and crop? Banana can be a fruit, banana can be a plantation. Banana can come under both the sectors. So what is the distinction? Where should I put banana? Is it horticulture? Shall I put it in horticulture or shall I put it in plantation? If it is a plantation, banana plantation cannot be done. Or say bamboo plantation, we had one a client from Assam who wanted to have bamboo cultivation, and they wanted to have 1,000 acres of land under bamboo cultivation, and they wanted to raise funds from foreign countries. No, not possible. Not possible. So only these can be possible. Now come to this sector 2, mining, petroleum and natural gas. In that also you find most of the places India is open now. That means country's economy is open. Anybody can come and mine here. Mining and exploration. The mining has 3 stages: exploration, excavation, and production. 3 phases. So if you have exploration of metal and non-metal, including gold, silver, diamond. Now these are all extraordinary valuable materials. Now here it is 100% on automatic route. So if I want to take gold production, a few years back I remember that there was a proposal for a mining operation. Mining operation means there are 3 operations. There are 3 operations. You can see that exploration is the first one, where people will try to see whether gold is there in that, in what stages gold is there. Then the excavation, they have to raise that gold. Then the mining operation, through the mining operation only gold can be raised. So there are 3 stages of operations. Now it was asked that the Australian company, he wanted to pour in 100% capital in India for having mining operation of gold near Kolar, because one of his chief engineer, who was an Indian, an expert from that local area of Kolar, they have indigenous way of understanding whether gold is there or gold is not there. So he said that there is gold after this many seams of layer. The 7 seams of layer, there is definitely gold, he assured them. So on this mining engineer, Australian company had blind faith. They wanted to put any money. Now, mining and exploration, but excavation is not there, extraction is not there. That actually was the point of issue, and then it was found that no, it is not possible to get the money from there. The coal and lignite, it can be only possible 100% automatic route only for those who are producing electricity for their captive plant. Every electricity company and many other iron and steel company, they require huge consumption of electricity. For them, they have a different plant. This is called captive plant. Now, captive plant, the use of the captive plant, if you have the mining of coal mining and lignite operation, is possible. But condition is that 30% of the production must be consumed by that industry, and 70% you have to give it to the main channel, the public channel. Petroleum natural exploration, marketing infrastructure, pipeline, in the refinery industry, in the private sector, in the private petroleum and natural gas exploration, marketing infrastructure, pipelines and refining, in the private sector it is 100% automatic route, but not in the public sector. If it is a public sector, refining, public sector refineries, India has a lot of public sector refineries in the country. Now say Haldia refineries, now there you have 49%, up to 49% only automatic route. Above that you have to go to the government. Up to 49% is the automatic route. Now, if it is a defense, about 10 years back people could not even think about that defense should be foreign, exposed to foreign funding and private sector. Defense was completely and exclusively the government sector from the very beginning, from the ordnance factories. That was ordnance factories, first ordnance factories was started in Chennai, near Chennai. That was in 1826. So from that, then you have Kashipur, then you have ordnance factories in Kanpur, so ordnance factories in Jabalpur. There are several ordnance factories during the British time. It was completely 100% government, and there was no question of any private operations. For defense industry, if you have license already, then for producing small arms and ammunitions, you have 100% foreign exchange is available, but up to 74% automatic, beyond 70% approval. These arms and ammunitions are now sold along with the ordnance factories production. The defense industry seeking industrial license. Defense industry having industrial license. Defense industry having no industrial license, but they have the government approval. In that case, they can have up to 49%. Beyond 49%, they have to go to the government of India for getting approval route. Now, sector of manufacturing. Manufacturing is completely open now on any issue: cement, paper, aluminium, sheet anchors, shipbuilding. So any manufacturing side is completely open, 100% on automatic route, and selling on manufacturers can also sell on wholesale as well as retail, and on that actually there is no restriction, 100% automatic route. 100% FDI through approval route is retail food. If the manufacturer produces food products, then in that case it is 100% through the approval route, 100%, and selling the retail. Manufacturer producing food items like say cornflakes, and then that cornflakes they want to sell on retail, they have to go for 100% FDI. For that approval route is necessary, so they have to get the approval. Now broadcasting is one of the very controversial topic now. Almost every day in the newspaper you find that there are controversies on broadcasting rights. So it is broadcasting, all teleports, setting up, uplinking or establishing hubs or teleports. It is 100% automatic route, but generally if you find in newspapers, there are lots of administrative restrictions on that. Direct to home, cable network operations, national or state level or district level, mobile TV, head end in the sky broadcasting services. These are all 100% automatic route available to foreign investment. So anyone can form a company here, get foreign funding and do this business. Then you have terrestrial broadcasting like FM radio is a terrestrial broadcasting. That is also 49% with the approval route. Setting up an FM radio, if you want to establish an FM radio to be established, at one point of time National Law School wanted FM radio to be established. Now in that case also 49% with approval route. Up to 49% can be, you can take foreign funding, and more than that you cannot. So that means management and control must remain in the hand of an Indian. That's why FM must remain with the hand of an Indian. Then uplinking of news and current affairs TV channels, 49%. Uploading, streaming of news and current affairs through digital media, this is only 26%. So digital media, if you want to digital media do a newspaper, suppose you want to have a news scoop and then upload in the news, every day you see that there are somebody is arrested, almost every day. Now there it is 26% only, 26% only is in the approval route, only 26%. That means if you have 100 rupees requirement, you have to pay 74 rupees yourself and 26 rupees you can take from foreign funding, but with the approval. Uplinking of non-news and current affairs, that is 100%. If it is non-news and non-current affairs, so if you want to publish say our Prime Minister's opinion about Ukraine war is a news. So there it is 26% and you have to take approval, then only you can publish it. But if it is nothing to do with that, it is only non-news, then in that case it is 100% automatic route. Publishing newspapers and periodicals of Indian editions, foreign newspapers, but Indian editions. Say Observer, you want to Observer's one issue, if you want to have published in India, then 26% with approval route. Scientific and technical journals, 100%. Facsimile of foreign journals. Now if you go to the airport, you will find lots of facsimiles of Telegraph, New York Times, these are all available. Facsimile of foreign newspapers, it is 100%. Aviation sector. About 6 or 7 years back, we had an inquiry when the new second airport in Bangalore was to be constructed. There was an inquiry whether they would require government approval for foreign funding, because the entire fund has to come from Singapore, because their co-partner was Singapore Airlines. Now it was then advised to them that since it is an existing airport, so it is 100% automatic route. Greenfield, Bellary is one which I remember just now often, that we did some part of work in Bellary airport. In Bellary airport also it is considered as a greenfield. Any district or subdivision in regional airports are all greenfield airports. where 100% foreign funding is possible. Scheduled air transport services. Scheduled air transport services means the goods you send by air. So goods are sent by air, in that the goods services is called scheduled, like say DLF has a scheduled flight. Now those schedules are 49% automatic route. DLF has, then you have that in Lufthansa they have goods flight. Now these are all 49% automatic route. Foreign funding is possible. Domestic scheduled passenger flight, say at one point of time some economy airlines, they wanted foreign funding, economy air flight. So these are domestic scheduled passenger flights. Domestic scheduled passengers for 49% automatic route. That is 49% means what? 49% means that management and control must lie with the Indian entity. Management and control will remain in the Indian entity if it has 51% shares. 49% shares can come from outside. Then regional air transport service, 49% automatic route. Non-scheduled air transport service, non-scheduled, occasional. So you can go to the airport and to find out that there are many small flights, non-scheduled. You take hire and then fly. There is 100% automatic route. Helicopter service, 100% automatic route. Ground handling services, for ground handling of materials and human being. Now it is 100% automatic route. Maintenance and repairs, 100% automatic route. Flying training institutes, Jakur flying institutes like that. Jakur now wanted about 500 million foreign funding. Now Jakur can take it 100% automatic route, so no permission is necessary. Training, technical training of institutions. Now these are also 100%. Construction development is a critical area because economic resurgence, economic growth depends virtually on the planning and development of townships. Now this is not included in real estate business. In that 100% automatic route for development of township, commercial building, roads, beaches, hotels, resorts, educational institutions, regional infrastructure building, they are 100% automatic route. There are conditions, of course, and each phase of development is a different one. Say phase, Nagarvavi phase 1, Nagarvavi phase 2, Nagarvavi phase 1, for that it is a separate, Nagarvavi phase 2 separate. So phase wise separate project. What happens, generally people who bring money, foreign fund, they want to get away. They want to go back as soon as possible with their money and also further income that they have earned. That, if you have exit only after completion of the project, you can exit only after completion of the project. There is a lock-in period for 3 years. For 3 years, if you invest, you cannot get out with the money. But a non-resident Indian, non-resident may transfer to another non-resident. So if I am an American, if I transfer my share to another American, within the 3 years period, I can get rid of money, I can get back my money. That is not considered as 3 years. Hotel, resort, education, these are all those. Then you are subject to rules of the state, all that rules, the local company, the Indian company has to take all rules and regulations of the state, because land belongs to the state. So since land belongs to the state, all land laws or municipal laws, they must be complied with. So land compliance is one of the big deal of the law firms. They take the land compliance, because without land compliance development cannot start. Industrial 100% satellite establish a 100% automatic route. Only it has to follow the guidelines of ISRO. Private security agencies. So now private security agencies are plenty. So foreign fund may be necessary for even having a private security agencies. Now I can manage private security agencies with 26 of rupees of mine, but 74% can come from outside. But even if 74% can come from outside, 49% only automatic route. So 49% can come under automatic route. Another 25% may come with approval route, but maximum is 26 to 74%. 26% must still remain with me, because 26% is necessary to keep the company's structure in its original form. Company structure is constituted by memorandum and articles of association in a particular form, and that structure cannot change. That is the indicator of 26%. Telecom, you see, telecom infrastructure providers, category 1. These are the telecom category 1 people. Basic cellular, United Access, UAS, Unified License, all these public mobile trunk services, global mobile trunk services, these are all 100%, but not 100%, but not completely automatic. It is up to 49% and beyond 49% approval. 49% is automatic, beyond 49% is approval route. So if you establish any of the small, generally these are now many of the small firms are entering into this area. So there they can take the foreign funding, but they cannot take foreign funding beyond 49% without approval. Approval is necessary beyond 49%. Trading. Wholesale trading metro, cash and carry metro services. You have a metro here. Wholesale cash and carry. That means if I have to go to the cash and carry metro market, I must remain in possession with my card, turnover card. Okay, so then only I can enter, and cash and carry means I can pay cash, no credit. There will be no credit system. It is 100% under automatic route. E-commerce 100% automatic route. Single brand retail is, I say, like say Bata shoe. Single brand retail 100% under automatic route. But if it is a multi-brand retail multi-brand, then in that case 51% under approval route. Now there in the country is divided on this, on the retail trade, when actually these big businesses, they started Reliance, they started their big business, retail chain. So when you have retail chain, agriculturists, they do not take it lightly, because these people are high risk. So they go and completely take away from the grassroots level, and the entire middle class people, they are completely annihilated from the market. So all the retailers lose their job. So it is from ground to market. Multi-brand retail is a from ground to market. That's why it is 51%, but with approval route. And in the approval route, they generally, government prescribe many of the things before giving approval. Duty free shop 100%. Now I told you about railways. Railway has been now divided into various sectors. Two important divisions. One is called railway operation, which is completely state driven, but otherwise in infrastructure. So metro, which is in PPP model, private public partnership model, PPP model. So companies, metro can get 100% foreign funding from outside. Similarly, track improvement, signal improvement, electricity improvement, all those improvements wherever it is, there's an infrastructure building, engine manufacturing, all that where infrastructure building is necessary. Infrastructure means the rail track, infrastructure building. Now there everything is now in the hand of private sector and public sector together, and it is based upon approval route and generally on PPP, private public partnership, but 100% is possible with prior approval of the government. I think that is the policy issue. So this 100%, 50%, 100%, 74%, now when you are hear this, you have to have a kind of understanding why. 100% means closed. Well, your door is completely open. So anyone can come, anyone can go out. 100% that means. Entire capital may come from outside. 74% means you must have in Indian, with Indian 26%, 74% can come outside. 26% why? Because in that case, special resolution is not possible to alter memorandum and articles of association. 26% have to be here with you so that your memorandum and articles of association structure remains unchanged. Then you have 49% because management and control must remain with the Indian company. So Indian company must have 51%, 49% can come from outside. 24% means that no major resolution can be taken. No major resolution can be taken because you are a minority. You cannot appoint your member of the board in the board meeting. Now all this therefore have a kind of a policy directive. I think that is the crux of the issue of the foreign funding, foreign capital. Now this is all direct. They are all direct. What about indirect? Indirect also, we have to try to find out the route. Generally, when foreign funding comes to India, they want to have a safest route. Safest route means a route through which if they come, they will pay less taxation and their going back is easy. So taxation, they want to save taxation, going back of the money, taking the money easy. So they want a kind of step gap line, like say either Mauritius. So Mauritius is one. Similarly, there are many, Tini Island, West Indies, Tini Island. Now there are many this type of places which are tax-free land. Tax-free land. So what I do is I have a company, say X Limited company, X US company. They have 100% they want to bring India, 100%, say X India Limited. They want to bring 100% to X India Limited. Say $1,000 they want to bring. But if they bring that $1,000 to India and then sell that $1,000 to outside, well, taking back, they will sell these shares. So then they get say $1,200 or equivalent to money. Now if they take it, they have to pay now 30% tax on this 200 rupees. That means 60 rupees will be cut. They will actually get $114. So this 60 is a very costly one. So I want to save this money. Now there is an Indo-Mauritius treaty where Mauritius, money coming from Mauritius shall not have to pay this 60 rupees. So instead of US giving money directly to Indian company, US company goes to Mauritius and open a Mauritius company, Mauritius Company Limited, and brings that $1,000 to Mauritius company. Then Mauritius company gives this $1,000 to Indian company. Okay? Then when selling, going back, exit, when they go back, they sell this 1,000 into 1,200, for 1,200 they can take back 1,200. So they prefer the route of this route. Instead of coming straight, though it is automatic, direct, okay, and no government intervention is necessary, but in any case they have to pay the tax. So if I want to save the tax, instead of coming directly, I will come indirectly. Now in indirect method, where actually fund, I do not invest in the company, I invest in a fund. I am an American, invest in a fund which invests in India. Since Indian market is bullish, Indian production is high, employment opportunity is high, profitability is in India high, American profitability is low compared to, in America, if I put in 100 rupees, very mushkil se I will get back maybe 2 rupees at the end of the day. 100 rupees will give me, $100 will give me at the end of the year $102. But in India, if I put $100 in a bank, I get at least 105 rupees at the end of the year. Now that's why in the retail, when you have indirect, so there are venture capital. Now I just say investment banker, foreign investment banker, foreign US investment banker, US Investment Inc. I want to put my money in US Investor Inc. US Investor Inc. will put the money, will bring the money to India and invest in the share market. This money comes under share market. They are share market registered players. They are called investment bankers, so they have to apply to SEBI, get the license from SEBI. First they have to get the approval from Reserve Bank and then get the approval of SEBI for establishment, and then they come with that. They go to the market and buy shares from the market. When they buy shares from the market, they use my money. I am a US citizen, I have put my money here. Okay? I am not interested where the money is. I am only interested that at the end of the day I must get the maximum dividend, maximum return. I must have a risk. I shall not take any risk to my money. That is what I put my money here. And US citizen will put the money here and this money will come to India. But this money will not come to India directly, because if going to back again, you have the same problem of taxation. So if you have a profit, when the profit goes, only profit, suppose $100 comes over here, profit is suppose $10. When the profit goes $10, it reaches $7. 30% is gone. So what I do is, this company that has a Mauritius company, Mauritius investment company, okay, Mauritius investment banking company. Mauritius investment banking company. Now this Mauritius investment banking company then registers with the share market, Bombay Stock Exchange. Instead of me enlisting in the Bombay Stock Exchange, instead of US company enlisting in the stock exchange, Mauritius company will be enlisted in the stock exchange. US company will pump in the Mauritius company will be enlisted in the share market, and they will operate in the share market. So that any profit, whether it is a capital profit, there can be capital profit. If I sell the share, is a capital profit. So 10 rupee share, I bought it for 50 rupees, I am now selling at 150 rupees, so my capital profit is 100 rupees. I 10 rupees share, my dividend is 5 rupees, so I have to get this 5 rupees. In order to maximize this, what I do is an American citizen's money here in the fund, American fund, they invest in Mauritius fund. Mauritius fund comes to the Indian market to operate. Right? In that case, what will happen is you save your money. There is another angle also nowadays, which is use of intellectual property, like patent, copyright. These are intellectual property. Patent, copyright. On software, what is that available? Patent available? Software? Software. When I have a software, generally patent is not given. I have a copyright. So I write a book, I get a copyright. I prepare a software, I get a copyright. Okay? A trademark. Trademark, design, brand name, design brand name. Okay, goodwill. Trade secret. I have produced some information which is very secretive. Generally, software companies have many things on trade secret. It goes from person to person. It cannot percolate to the customers. So all these that you have, the integrated circuit, these are all transferred. A company is a US company, they will sell their all this to say Cammy Island company. Cammy Island company. So a company in its balance sheet doesn't have any of this. So that company is sold. Company as a whole sold. But when the company as a whole is sold, its intellectual property remains with somebody else. Okay, so a software company, its intellectual property in Cammy Island, tax-free island, okay, where there is no tax, there is no incident, there is no operation, there is no registration, nothing is there. Okay, there is a company, and that company is the owner of this. So whatever income I have out of this, whatever income I have out of this operation, entire profit is profit of that company, and that company doesn't pay tax. Okay. Now this US company transferring it here is called transfer pricing. Transfer pricing issue.
So when my company, the US company is sold, it doesn't have any of this. That means you have a structure, but content of the structure, intellectual property is out. Somebody else have it. So you get only the structure, you cannot get this. So when you try to conciliate, then this conciliation is done by the transfer pricing issues. They will put that, the transfer will be equivalent to, say this is X price, this is Y price, X plus Y will be the price. Generally in buying and selling of the properties, that is what is needed. So entire operation gets complicated more and more. So foreign investment indirect, I told you, fund comes through a fund manager, and fund manager operates, and he is therefore looking after the
lowest income tax incident paying station where they will be located. So their platform is there in that less taxation land. So a foreign investment company, they have to first get the approval from Reserve Bank to operate in India, and then registered with the SEBI as an investment banker, and then they can be a player in the stock exchanges and operate as usual. In India, supposing this is India, now in India, one station in Calcutta, Bombay, Chennai, and there are many small issues. There is a scheme called SEZ, S-E-Z. Okay. So if there is a SEZ company, these are called free taxation zone. Free taxation economic zone, self-contained economic zone. So you have to, government has to declare, the state government has to give the land, suppose this is the land given by Bombay, declare that this land is the SEZ. So anything that comes there, this will be as if treated as a foreign land. So anything coming over there, they will not be charged taxation. So anything land up there, suppose steel comes there from Tata. Is Tata company steel, so that's why Tata company doesn't tax on Tata company's product. Now when it goes out for sale, right, there is no sales tax. No sales tax. So there are lots of SEZ. Near Delhi there is SEZ, near Ajmer there is SEZ, near Udaipur SEZ, there Ahmedabad there is SEZ, there Calcutta SEZ is not there because government of West Bengal doesn't want SEZ. They do not allocate land. So Chennai has got SEZ. So Bangalore has got SEZ. Earlier there was SEZ, there was a limitation of land, that at least 25 acres of land would be necessary, 100 acres of land would be necessary. Now that limitation is also not there. So any land can be earmarked as a SEZ, and even it is a company based SEZ, that is also possible. SEZ, company based SEZ. So in SEZ there will be no taxations. Outgoing taxation is not there. Incoming taxation will be there, but outgoing taxation will not be there. So these are all privileges for foreign investment. Small and medium industries. Small and medium enterprises, SME, is 100%, if you invest 100% automatic route. but management and control must be with Indian enterprise. This particular condition is not there if it is not SME. It is a large scale industry. Well, I take over 51%, I get the management. Here, even if you have 100%, management and control will be Indian enterprise. And of course, lastly, the double taxation benefit. Suppose X has invested say $1,000 to a fund, US fund, which has invested in India through Mauritius fund. So if there is a profit of 100 rupees in that transaction, $100 profit, now India charges 30% tax and US charges 20% tax. So actually I get 50 rupees. Now this is offset, this is called double taxation. I get a double taxation benefit. So that means if I give 30, I pay from my amount 20 rupees here, so that he is not to pay any tax here, no collection at the receipt. So total taxation would be 30 rupees only. So there is a double taxation benefit. This is called tax set off. Taxation amount already paid is set off. Finally, let us have a kind of a case law. A real estate company, say for example, Sriram requires $500 million investment and negotiated a German company, say German company, German co. From that German company, they negotiated $500 million. The condition is that if they want equity, they can get equity because 100% and automatic route, but they do not want to be an investor. They want to give you a loan, long-term loan, but they do not want to be an investor. So you issue non-convertible debenture. So issue non-convertible debenture on the ground that the first tranche of money which will come on the first year itself of the agreement will go back on third year. Second tranche which will come in the second year will go back in the fourth year. Third tranche will go back in the fifth year. So the three tranches of money will go back like that. And in each tranche, so actual how many amount will come? $500 million USD. This will come from a German company to an Indian company, Land Development Indian company. So say ILD company. ILD company is an Indian company, will receive German fund of $500 million, but they do not want to give equity. So instead of equity, they give non-convertible debenture, non-convertible debenture. the condition agreed upon is that this 500 million will come at 150, 200 first year, first tranche, 200 second tranche, and third tranche, but 100. So it will come on 2013, 2014, 2015. It will go back, agreement is that it has to go back on 2015, go back. This money will go back in 2017. But condition of investment is that there is a 3-year lock-in period. Three-year lock-in period. That if you do not have 3 years lock-in period, the agreement is void. The question is how the money will go back, because there is a lock-in period. Money can go back in the following manner. One, from NR to another NR. This stick, if I sell to a German, mine is a German company, I sell it to another NR, then 3 years will not be required. 3 years, that limitation period will not be there, lock-in period will not be there. So in all the tranches I can transfer like that. This is one. Second, there is an agreement, they say Indian company will buy back. If this is not possible, they say Indian company buy back. The Indian company, how can Indian company buy back? Because if Indian company buys back, then foreign investment will go. It will no longer be foreign investment. So foreign investment is locked in for 3 years. Each tranche will be locked in for 3 years. So this clause cannot operate. Now if Indian company has got a foreign outfit that buys, then is okay, right? And fourth, project is completed, complete the project. So first tranche project must be completed. It has come in 2013, by 2015 it is completed. So project is completed, it can go by exit, there is no limitation to exit. It can exit. This tranche work must be completed by 2016, this tranche 2017, so that money can go back in as soon as work is completed. Now if that is also not there, then fifth, Indian company can sell the stake, their portion, to a foreign fund. So there are this type of escape routes are there, so that even if I say I will pay for, this logic becomes bad because foreign funding is not there. This is not possible. It's not done like that. External commercial borrowing. Foreign funds can be allowed on borrowing scheme called external commercial borrowing. External commercial borrowings for the development of a company, for restructuring of a company, for upgradation of a company, for upgrading the technology of a company, it is allowed 20 million for 3 years and 50 millions for 5 years. The same can be if it is an infrastructure company or a developing company, developers company, or a company of special nature like railway construction, railway projects. Now in that case, the commercial borrowing can be up to 200 million for 3 years and 500 million for 5 years. All money must be channelized through usual banking course. Liberalized remittances scheme.
Of RBI,
in which case every citizen of India, every person resident, I said no citizen, resident in India, resident of India in every year can take from India $200,000 for various objectives, like say fees for educational institution, donation, foreign investment. So each individual can have, within that restriction, also invest in foreign countries outside India, and every citizen can take $200,000 every year outside India from India. Now I think with this my discourse on investment is complete.